I wanted to come on here today and talk a little bit about a cross-selling objection strategy I've been talking to a lot of our agents about recently. And this often comes up a lot when we're talking to our consumers about cancer insurance, specifically, is one that I hear this objection from a lot of agents on. And the consumer always has the thought and the concern of, well, if I pay for this for all of the years and I never end up needing it, I'm just out that money. And I've paid all this and I've never used it. And there's a couple ways that I like to think about approaching that. One of them being, we also hope the same thing about our car insurance. We pay for that every month, hoping to never actually need to use it. But on the flip side of that, I like to think about a mathematical approach to that. And for those of you that know me, you know that I like data and I like numbers and I like approaching sales from a data and a numbers standpoint because let's be honest, that's what it all is at the end of the day, is making the numbers make sense. So we're gonna take and I've got a sample quote here in front of me on another screen, and I'm gonna write it on this whiteboard so that we can actually all physically see it as well, because I'm a big believer in that. So we're gonna have a 15,000 lump sum face value policy. Now, the quote that I ran was for a 65-year-old in the state of Missouri. So these are our quote demographics here, and pardon my chicken scratch for handwriting on this, but the monthly premium on that came out to $33.68. Okay, so $33.68 times 12 months. So that is an annual premium again of $416.10. If we take 15,000 divided by that annual premium of 416.10, that consumer is going to have to pay for that plan for 36 years before they've broken even on that, from premiums paid in to benefit amount. Now think back to the start of this. I said that our consumer was 65 years old in this quote. If we do 65 plus 36, we're looking at someone that's 101 years old when they would hit the break-even point. And I like to take a look at it this way, because if you're sitting down with your client and you were to say, okay, you're 65 years old today, here's what we're looking at on an annual spend on a cancer insurance policy for you is $416.10. If you keep this policy for 36 years, you will break even on the premiums paid in to the lump sum amount if you were to get a diagnosis. If you turn 101 and you have not needed to use this policy, two things to say. One, what an absolute blessing to have lived that long, that fruitful of a life, and never needed your cancer insurance policy. And two, we can cancel it for you at that time. I really like this approach because it helps to put everything into perspective for our clients. When they just see the annual payment amount on that, they can sometimes have a little bit of a sticker shock and be like, is it really worth it? Do I really need it that badly? Can I maybe just call next year and get it? But when we math out the lifetime of the value of this policy, it is absolutely so worth it to have these and to be talking about it to our consumers. That I think, for me, the math always makes sense on it. But that's an approach that I really like to take, is take the benefit amount divided by what their annual premium is to see how many years they'd need to pay into that policy before they're no longer getting an excess in what they paid on premiums to it.